I recently met with some clients and they've amassed a fair amount of wealth. They've maxed out their tax-free savings accounts. They have a sizable amount in registered funds and also non-registered funds. So we looked at a few alternatives for them. And with me having my CLU designation, stands for Certified Life Underwriter, I learned a lot of advanced tax planning things to do with clients. And one of them is to purchase a life insurance policy and to make a charitable organization the owner and the beneficiary. So these clients, we figured they need to take about $50,000 a year out of their investments, and this will not affect their lifestyle at all. It will not affect their ability to run their household. But how we set it up, and make sure you talk to a financial advisor before doing something like this. I'm just going to give you the very abbreviated Coles Notes version of how to do this. But basically, this particular couple, they purchased the policy and the charitable organization is the owner and the beneficiary. And then each year when they're making a $50,000 payment on their life insurance policy, they get to use this as a tax deduction. Now, sometimes people wait to designate the charity in their will as the beneficiary, or if you're making a monthly payment, it may make sense for you to get that monthly tax deduction. Everyone's situation is unique, so make sure you talk to somebody that has experience. You do need to make sure that you set it up properly so that there aren't any issues with the CRA and trying to use this as a tax deduction. But that's the way I've been able to help clients. And it doesn't have to be $50,000 a year either. In this couple's case, that was the amount that made sense, was for them to take $50,000 a year out. You know, it might be $1,000 a year or $10,000 a year extra that you have. And maybe you might want to leave a legacy to, you know, the Canadian Cancer Society, if someone in your family's had cancer, Humane Society, or whatever organization is near and dear to your heart. Just make sure you deal with a financial advisor that has the designations, that has the background in place to make sure that you're structuring things properly. The last thing you want to do is purchase a policy and not have it set up properly and not be able to get that tax deductibility option for yourself. If you have any questions, give us a shout.